when that housing bubble, burst. So it started with banks, lending and offering mortgages to people that had poor credit. And then the lending standards went down, demand and increase demand for houses went up, and then prices go up. So now you've got the housing bubble. But the asset prices it became unsustainable because the prices became value of the houses were not measured with the actual value. And so the investment community did something, the mortgage companies did something, along with the government. They all exactly knew what they were doing. What they decided to do is they took all these mortgages and they would bundle them up together and they would sell that as a security to investors, a bundle of mortgages. So the security was like backed by the mortgages. So it seemed like a good investment because you had all these mortgages backing it, all of that housing inventory, right? But the problem was the security is backed by loans that were most likely going to default. So what happens when there's inflation? Interest rates go up. Bad economic data, interest rates start to go up. And then the housing market starts to cool. And homeowners that had all of these mortgages couldn't make the payments because their credit card was racked up because of inflation and because of interest rates going up. Layoffs started to happen. So demand goes down. Now they can't pay. Does this sound familiar? Same exact scenario, except different bubble. Uh-oh. So as they started to default on the mortgages, the investors realized it. So they dumped the securities. And these financial institutions that held a lot of the assets